Good morning and welcome. You're watching another episode of the Small and Mid Cap Show today. Thanks for tuning in. We have a very interesting lineup for you going forward. First off, we have the management of Kolte Patil developers. Now, real estate companies in general, in terms of returns, stocks have been on a tear. And to understand some of those trends better, we have Rahul Talele, who's part of Kolte Patil's management, and he's going to break down some of the numbers for us and try to take us through what trends are playing out in real estate at the moment. Welcome to the Small and Mid Cap Show, sir.
Yeah, good morning. So certainly this year has been a phenomenal for the industry and for Kolte Patil as well. So we have done the highest ever business development in last 10 years in this year, around 4,000 crores worth projects we have already acquired. And having said that, there is a strong pipeline of further business development opportunities, which will get fructified in next few quarters. Also, we have launched around 3,000 crores worth inventory in this financial year. So I'm planning to launch 2,000 in this quarter itself. So again, a highest ever launches in the history of company. Having said that, we have achieved again a highest ever numbers in 9 months in terms of pre-sales number, which is a forward-looking indicator for real estate company. And we are confident of matching or surpassing our 2,800 crores of pre-sales number in this financial year. Also, we have very strong launch pipeline for the next financial year with around 7,000 crores worth projects, and we are confident of those launches as well. So entire business development has been completely done for those projects. In terms of the industry, yes, currently the affordability is very good. If you compare the household income and the EMIs the customers are paying, so across the it is the best ever in last 10 to 15 years. So that is pushing the sales. On top of that, there is a strong desire to purchase a property post COVID. So there is a very strong desire for a good branded development. There are accumulated savings. If you see the wage growth in last 10 years, phenomenal. Again, that the property prices, the betterment is very limited. So considering the strong tailwind in the industry, the good macroeconomic indicators, we feel that there is going to be a very strong demand. So currently we feel that we are just in the first half of the entire cycle, and next 4 to 5 years are going to be a very good for the industry, and we are certainly trying to capitalize on this positivity in the industry.
Right. So that's a good backdrop of how things are at the moment. But let me start coming more granular with regard to some of your numbers. Now, you've guided for roughly an 8,000 crore of BD pipeline in FY24. You've done around 30, maybe 3,500 odd in the first half of the financial year. So 4,600 crore to be done H2. Where are we now? Is that still continuing to be a realistic target?
So we have already done 3,500 in H1, and we have just announced around 5,550 crores worth deal in Mumbai a couple of days back. So currently we are sitting with 400 crores of BD achievement. And having said that, we are consolidating our position in our flagship project. So over there, we have already acquired the lands with a GDV potential of more than 2,000 crores. So if we add that, the GDV that we have already achieved is more than 6,000 crores. But in business development, there is we follow a very stringent due diligence process, and sometimes it is very difficult to predict on a quarterly basis, because see, till the time we don't, our consultants, our internal diligence teams is not confident about their the entire due diligence, we don't proceed with those deals. And that's the beauty of this company, that whatever the deals that we have closed, we have delivered on those projects with good margins. And so there is a very strong pipeline of launches, and in next few months certainly we are going to announce multiple BD closures. So we are confident of matching this guideline, but not maybe by March, but there can be a spillover of couple of months, but we are confident on that.
Understood. And what would the geographies be like for the new BD that you're doing? Of course, 2,000 crore in your flagship, as well as 2,000 crore incrementally going forward. Where do you expect that to be at roughly in terms of geography?
See, currently, our aim is to diversify around 30% beyond Pune as we speak. From that perspective, in this financial year, our focus was on Mumbai, and we have done BDs of more than 2,500 crores in Mumbai in this financial year itself. These projects will get launched in next financial year. So, diversification target can be comfortably achieved. Simultaneously, in terms of the future or ongoing BD, progress. So there will be a combination of some deals which will get announced in Pune and a couple of deals which will get announced in Mumbai.
Understood. A couple of them in Pune, a couple of them in Mumbai. Let me come to pre-sales, therefore. As a subset to this, where would pre-sales lie? As context, of course, first 3 quarters, you've done pre-sales of roughly 2,100 crore. And where should that therefore go, given the kind of pipeline you have or the kind of BD potential that you have over Q4 alone, which is roughly 4,000 crore from what I understand?
So we are planning to launch around 2,000 crores worth project in Q4. So considering that and considering our opening inventory of Q4, we are confident of surpassing or matching our target of 2,800 crores of pre-sales number for this financial year. And we are expecting at least 25% CAGR for next 2 years in terms of pre-sales number. And we have strong backup of launches to achieve these numbers.
Understood. Got it. And, with regard to realizations, I've seen that your realizations have gone up quite sharply. Is that only premiumization? What's at play here? And is that number sustainable, or are you now moving into more premiumized projects in any case, and therefore that's the new normal?
So if you see, there is a constant efforts to improve our, the realization across project, across geographies. So if you see, there is a price rise that we have achieved from 7-8% to 15-17% in last 3-4 quarters. And, so we are confident of bettering our price realization going forward as well. So we try to categorize our inventory into various buckets. So difficult to sell, moderate to sell, and easy to sell. So particularly for easy to sell inventory, or the premium inventory within the project. So we are charging a good amount of premium, and customer are ready to pay that kind of premium if we are offering a good product. And that is what we have observed. And going forward, also we are confident of bettering our price realization. So we are expecting around 7,500 kind of price realization for the next financial year on account of price realization across projects. And also it is a combination of, our better contribution from our premium project as well. So it is a combination of both price realization betterment in our across projects, and, the higher ticket size, higher price products are also contributing more.
So are you saying that it will now stabilize at 7,500, or do you still expect some, so 7,500 for viewer perspective is the realization, which is rupees per square foot. So do you expect that to be maintained, or do you expect to continue to build on that going forward?
Certainly wherever we find an opportunity, we'll try to, capitalize on those opportunity. And this price realization is merely a function of which project is contributing more in that specific quarter. If my MIG product is contributing more, so just to give you an instance, in this quarter, our price realization, the concluded quarter price realization was more than 7,500. But last quarter, it was around 6,700. So for this 9 months, it is, on a yearly basis, it is the right parameter to calculate price realization. On quarter basis, there can be ups and downs depending on which project is contributing. But if you just to tell you about our flagship project, which is contributing, which is a highest selling project in Pune, over there we have a price realization has gone up from 4,800 rupees per square feet to 6,400 rupees square feet in last 2 years. And certainly we are planning to launch 2 more sectors in that flagship project at a better price realization. So there is a constant efforts to better price realization without hampering our, the guidance. And that is what we are, continuously doing in order to better our margins.
That makes sense. Before I come to margins, is there an appetite as well, given the higher price realization that you're demanding? What's the appetite like? Is the customer still absolutely willing to purchase, or do you therefore start to feel that at slightly higher price points, there are far lower customers now that you're catering to?
See, there are 2 points. One is the affordability. If you compare the affordability matrix, the EMI component against the household income, that is one of the lowest in last 15 years. So because of the affordability, customers are willing to invest in the end use driven houses, and we are confident about this trend going forward. There is another element which is a demand supply. So inventory replenishment ratio is around 1 as we speak, so which gives us a good edge to improve our price realization, because whatever the inventory is getting sold out, so the same or maybe a lesser inventory is getting launched in the geographies where we are currently operating. So that is giving us an edge, being a good strong brand in Pune, as well as we are established brand in Mumbai as well, so to better our price realization.
Understood. And my last question is with regard to margins. So therefore, where do margins lie? You're guiding for a roughly 7,500 annualized kind of a number for price realization. Where should therefore margins be for Kolte Patil?
See, whatever the inventory that we are selling in last 4 to 6 quarter, which will get the revenue for that will get recognized. Recognition will start in FY26 last quarter onwards. So for that we are confident of achieving the EBITDA margins of more than 20 to 24% at a corporate level. But till that, since it is a growing company, our overheads are more. So because the overheads are getting recognized on a real-time basis against the revenue of the past. So there is a mismatch of the timing, and because of that, there can be a distortion in margins from a short-term perspective. But certainly we are confident of maintaining our margins at the project level, and which will get fructified in the FY26 onwards.
Absolutely. Thank you so much for that, Rahul. It's been a comprehensive chat with you with regard to how real estate is moving, as well as how Kolte Patil is doing. Again, congratulations on a strong set which you continue to deliver, and it was good speaking with you. Thank you for all that perspective.
Thank you.
Right, with that, we'll slip into a very short break. More on the other side. Stay tuned to the Small and Mid Cap Show. Welcome back. You're watching the Small and Mid-Cap Show here on NDTV Profit. Thanks for staying tuned. We'll stick with earnings. We've spoken with the management of Kolte Patil. We'll switch over, completely different sector. MRPL also disclosed its earnings, and we'll try to get some more perspective with regard to some of the numbers disclosed from Sanjay Verma, who's the managing director at MRPL. Welcome to the Small and Mid-Cap Show, sir.
Yeah, thanks for inviting us. Good morning to you.
Yes, sir. Good morning. Sir, how were the numbers overall in Q3? What do you assess of it? You had one unit which was shut for around half of the quarter. How do you assess the quarter?
I think if we see the historic Q3 performance, the results are slightly subdued. It is mainly attributed due to the volatility in the market. And the main reason for the subdued results are basically because of the inventory loss. And overall GRMs were also low. Singapore GRM, if you typically see from Q2 to Q3, it has fallen down roughly around by $3.5 to $4. As far as your question is concerned about the unit shutdown, we had a major shutdown in Q2 that we have already completed in last quarter itself. And all units have been put to operation. And in fact, this quarter, we could, have a very good physical performance. Our capacity utilization was around 117.7% capacity utilization. So as far as the physical performance of the refinery is concerned in this quarter, there are no issues. We have done extremely well over there. But results historically, Q3 is, a good quarter for refiners, including MRPL, because of the winter effect in, west part of the world. So we get a good cracks. So these are the two reasons which have, caused a little subdued result, but we are happy to, post a profit of around 2,459 crores in a 9-month average. And the last 9-month average of last financial year, we were only 730 crores. So that way, if you see, we have our consolidated profit stands pretty good at this point of time.
Sure, I take your point. So, you did speak about the macro, you did speak about how GRMs are evolving. Where do you see, it's a volatile environment, it's a tough environment where the business is concerned, but where do you see GRMs really evolving in Q4, if you can have a crack at that? And also, how do you see this impacting your performance in Q4, and where do you assess full year FY24 therefore?
Fine. See, it's a bit difficult question because prediction of the GRM forward-looking becomes extremely difficult because you see the geopolitical situations are slightly unpredictable. We have two conflicts in an adjacent area, which impacts our supply chain, and even the products which are exported are getting impacted out of it. But looking into the 3 weeks of January operation, I think the crude has almost in a stable range as of now, and GRMs also looks to be in a a reasonably good level. And Singapore GRM, if you see, has in month of January as on this date, is around $3 up than the previous quarter. So we look for holding on our GRM of 9 months. What we have got is close to around 10. So 9.98 something is our GRM for the 9 months gone in this financial year. So we are optimistic that if something drastic doesn't happen in a geopolitical scenario, we'll be able to hold on to that kind of a GRM.
Right. So let me talk of demand. Of course, GRMs fully get very volatile. It's a tough one to predict.
Yes.
Where do volumes go from here? You're expecting around 1 MTPA or thereabouts as your target, especially where the retail market is concerned. How do you capture that? How is the company prepping for that?
Well, if you if I talk about my company, it is a balancing refinery. Our all best endeavors are to, saturate the domestic demand to the maximum extent. And being a coastal refinery, we whatever is left over fuel is, exported. So this is one of the area where we have strategized to, increase our marketing footprint. And as you have rightly put up, 1 million metric ton per annum is our ambition to, grow in next 3 to 5 years. And we have our own MRPL retail outlet brand HiQ. HiQ denotes high quality. And as of now, we are operational in around 82 retail outlets in southern India. And we aspire to touch around 1,000 retail outlet in 3 to 5 years, for which capex is already, allocated in a phased manner. And the thing which I would like to, further add on to you is that MRPL products are well received by our customers through our retail outlet HiQ. And we are doing better with the nearest competitor by around 10 to 15% with respect to the monthly throughputs are concerned. So we are upbeat with the response what we have got from the customers, our customers. But the limitation is it takes time to put up those kind of things. But the company is fully focused. Apart from that, we have also, putting up a marketing terminal in the outskirts of Bangalore. And that marketing terminal will be operationalized in this quarter. We are just stepping into a mechanical completion anytime in another 2 weeks or 3 weeks time from now. And then it will be pre-commissioning, commissioning activity will be taken up, and that will put us an added advantage because from Bangalore refinery, it is connected through a pipeline. So our cost of placement will become, competitive. And we will be able to, cater our first phase of marketing footprint in southern India, for which we have already advertised around 1,800 retail outlet advertisement is floated last year, sorry. And we have got a very good response for it. This year also, we do intend to, come up with a retail outlet advertisement for around 1,000 numbers of retail outlets. And probably next year, another 1,000 retail outlet we are going to put it. The strategy is to first cover the South India and then move upward. So that is what we are looking into it as far as retail marketing footprint is concerned.
Right. And, with regard to how your gross crude input is evolving, it's at its highest that you've clocked in any single month in the month of December 23. Can you see that kind of number now sustained?
Yeah, definitely the Q4 outlook is that we will be able to, repeat a kind of a physical performance we delivered in Q3. As I told you, our major maintenance is over. Basically, MRPL has 3 trains of crude units. So these trains will go once in a 4-year for a major overhaul. So last quarter, that is Q2 of this financial year, we have taken a shutdown of our phase 3 refinery. And those units have been, put back into the operation. And there are no plant shutdown in this financial year as of now. So Q4 outlet also, I am expecting that it will be in a similar kind of a physical performance we'll be able to deliver.
Understood. And, where should you see margins on a normalized basis? I know it's difficult to call it in the short term, but where would you aspire that margin number to be at?
See, it is very difficult to say because the market, in a oil refinery, it's very much sensitive to how the international market, behaves. So it's very difficult. But as I told you earlier, Q4, we are looking for holding on to GRM of around 9.98, which is our average. We are able to, I foresee that there should not be much of the issue. Basis the January 3 weeks, whatever experience we have got of the market.
Understood. Thank you so much, sir. It's a pleasure speaking with you and getting all that perspective. That's, of course, Mr. Verma, who's the managing director at MRPL. But with that, we're completely out of time on this edition of the Small and Mid Cap Show. More on the other side. Stay tuned to NDTV Profit.